Today, we're going to talk about the health insurance cliff. This is for people that are not yet on Medicare, and it's really designed for anyone that's going on a health insurance plan in using the healthcare exchanges, the Affordable Care Act, Obamacare, whatever you want to call it. And we've done shows on this before, but I want to talk specifically because right now we're in November of 25 and the government shut down and we don't know what's going to happen with these insurance subsidies. So we need to plan and be proactive. And let me bring in my co-host, Tony Shore. Welcome to the show, Tony. We're talking about health insurance before 65.
Yay. I'm excited, Dan. Health insurance. Woo!
I'm going to keep it simple. I'm going to just bring up only two today, Tony, really important things that I want people to know. The tips, the top two things that people need to know about this. And this is timely because there's a lot of people right now wondering what's going on. When's the government going to open? And are we going to have the enhanced subsidies? What's going to cost me for health insurance? If you have a health insurance through work or you're on Medicare, this doesn't apply to you. Mm-hmm. But it's really, really important.
So this is really for people between when they leave a job where their healthcare insurance is subsidized by their employer. So this is for people after they're off their employer's health insurance, but before they qualify for Medicare, is what you're saying. So some people
if they don't have health insurance through work.
Right. Let's say I want to retire at 60 or 62. A lot of people think I can start taking Social Security. I'm going to retire at 62.
Early retirement.
Yes. That's called early. If you're retiring before you qualify for Medicare, it's for sure early. And before your full retirement age, I still count that as early. So,
which I don't like. I don't like that term early. It should be, that's when you should be retired. But again, I'm not going down that path.
For it. Okay. But health insurance has risen exponentially this year for so many people.
It's going to get worse. And so what I want to talk about is the top things that people need to know. All right. So let's get straight to the number one thing that people need to know, Tony. They need to know the income levels for the subsidy.
Okay.
They need to be aware of the subsidy cliff. And what do I mean by the subsidy cliff? We're going back now to pre-COVID now. Because pre-COVID, there was a subsidy cliff, and we've done shows on it. But that cliff was eliminated by President Biden when he passed the enhanced subsidies during COVID. And those subsidies are going away at the end of 2025, unless they're extended, right?
Right.
So the subsidies, all of them, including the enhanced ones, are based on federal poverty levels. I'm putting a link to those that are watching. You can go there and look. Federal poverty levels. It says this is the family size. You can have 1, 2, 3, 5, whatever, and how much income is considered the federal poverty level. Once you're at that poverty level, or once you look at what your income is going to be and compare it to the poverty level, that's going to determine your subsidy. And those subsidies are going to stop if you make above 400% of the poverty level. Now, the enhanced subsidies cover anyone above 400%, but those are going away potentially.
Wow.
So now people need to be aware of this again because that cliff is important. Let me use an example of two people, a married couple, and the federal poverty level for them, 100% of it is $21,150. 400% of that is $84,600. So I want to be very clear about this. If their income is below $84,600, this married couple, and that's modified adjusted gross income, they can qualify for a subsidy. And that's not going away. That's not being debated. What's being debated and what is planning to go away is if they make $84,601, they get zero subsidy. They don't get any subsidy.
And that's why is it a hard? That's crazy. That is a cliff. That's nuts.
The yodeler, yodeler. Price is right, yodeler.
Price is right. Yeah, we did a whole show on that.
Right? You remember it?
Yeah.
See?
Oh yeah.
Years ago. So I wanted to point this out. So this cliff is going to impact a lot of people. particularly those who are retirees that are in their 60s. They may have turned on Social Security. They may have a pension. They may be doing Roth conversions. They might be being strategic about pulling IRA money out. They may want to renovate the house and pull a big chunk out of their retirement to do so because they finally retired. They're ready to do it. And now they need to think twice because of this. Because this subsidy cliff is a real deal. You know what it's time for, Tony? What do you think it's time for?
I don't know. A rant? What are you going to do here?
Oh, you want me to rant, don't you? No, here's what it's time for.
Time for a real-world case study.
Time for a case study, Tony. All right. I'm going to share my screen. What I want you to do is pick a zip code that I'm going to use as the example. And we're going to use a married couple. So, and again, the subsidy limits are for individuals, married couples, or people with multiple people in the family. Give me a zip code, Tony. Can you see my screen? I'm going to healthcare.gov.
I can see your screen, yes.
All right. Give me a random zip code. Please don't pick Alaska or Hawaii because they have different rates.
A random zip code. Okay.
It's not a trick question. This is not a trick question.
Well, I want to make sure I get this right. Like, how about 53562?
53562.
Somewhere in Wisconsin.
Dane County, Wisconsin. Okay. I have no idea where that is in Wisconsin. Right. Okay. Of course you pick Wisconsin, you Midwest lover. Okay.
Cheese.
So
I was thinking of cheese. That's
all right. Are you married? Yes. So will you claim dependents? No. So we're going to say we're a married couple. The husband is 63, male, non-tobacco.
Oh, so you're not using me. I'm not 63 yet, by the way, folks.
And his wife is 62, right? Does that seem reasonable? 63 and a 62-year-old.
Yep.
Early retirees, right? Okay. So let's talk about their income. I just told you what the income level is. So let's say they make $86,000 because they have pensions and such. Look at what this says. May not be eligible for a premium tax credit. Well, if I go back and say they make $84,000, I hope this math works. Ooh, they get $1,800 per month in a credit. Big bucks, huh? Big bucks. But let's just go back to 86,000. Okay. So what I want to show is what the cheapest plan is. They have 49 plans available to them in Wisconsin, where they live. Dean County, I think it was. And look at Dean Health Plan is the cheapest plan, the cheapest possible plan for them for the year 2026 is $1,607 per month.
So over $1,600 for just a couple.
For the couple. And what does that get them? That gets them a $16,000 deductible and a $21,200 max out of pocket.
Ouch.
That is the cheapest plan
that
for them.
Doesn't even sound like insurance to me.
Well, it's true insurance. If you think about it, you don't want to use it, right? But if you don't use it, you're out $1,608 per month. Right?
And you're going to be 20 grand deep before you get decent coverage.
Right. So it goes up from there. You know, let's say, I don't like a $16,000 deductible, Dan. That's unreasonable. Let's sort by the lowest deductible. Well, you can get a deductible of $0, but that's going to cost you $2,772 a month.
Oh, good Lord.
Or $3,000 a month. Does this seem unreasonable?
Yeah.
Now it's more expensive where in your zip code. This is all zip code based. We don't know.
And it's not just the subsidies that are making it expensive. Without any subsidies and with subsidies, the actual insurance companies are raising the prices this year of their insurance across the board.
Yes, they are. They're raising it across the board. The key is, I just showed you that plan.
Yeah.
If that couple gets a subsidy, or the couple doesn't get a subsidy, the cost for the plan is the same. They're still going to have to pay $1,600 or $1,700 a month for the cheapest plan. Wow. Now, if they qualify for subsidy and they get $1,800 a month subsidy, Well, then they don't pay anything for the plan. But someone's still paying for the plan, and that's the government is sending a check to the insurance company. And where does the government get the money from? You and I and the listeners, right? So this is why it's important to note. Yeah, right.
They're robbing the
No, the tariffs. One big beautiful. The money's coming from somewhere. But I want people to realize the plans are ridiculously expensive compared to where they've been historically. It's going to cost $2,000, $3,000 a month. What if you have 3 people? Even if you're single, your subsidy is still, not going to cover these plans, generally speaking. You're going to be paying out of pocket for these. Now, how much is your subsidy? This is why it's really important to know that cliff. Yeah. Because in the case of that couple in Wisconsin, if they make $84,601 next year, they get 0 subsidy, and they're out $1,600, $1,700 a month on the cheap.
Oh.
If they make a subsidy, yeah, that's great. They qualified, now it's cheaper. But I think what's happening is people are forgetting that the plan's still costing. Someone's still paying for it. It's whether or not you're getting a government subsidy. And I think more and more people are now realizing, holy smoke, these plans are out of control.
They are.
Did I just rant? I didn't rant, right?
No. We know when you rant, Dan.
I'm not going to do that.
That was pretty soft-spoken compared to your rants.
So number one, Tony, you need to know this cliff, because that, as a prime example, we're looking at $20,000 difference potentially. Right?
It's huge.
25. It's not unreasonable to say, oh, if I get a subsidy, that saves me $25,000 for my family a year. Do you think it makes sense now? Should I do that Roth conversion? Should I do some tax planning so I don't fall over that cliff? What's the big deal? Oh, I pay a little extra taxes? No, you lose out on a subsidy, which could be $20,000 or more.
Wow.
It's no joke.
So you really have to be careful what you're doing for income if you're retired. And
right.
Yeah.
Especially with the enhanced subsidies gone. With the enhanced subsidies, you could still qualify for a subsidy if you have 400% or more.
Yeah.
But they're doing away with that. So now that cliff is back. It's high stakes again. And people who are new to the health insurance plans, subsidies, new retirees, they don't know. They're not
going to be paying attention to this because it's different. And that cliff didn't really exist before in this way.
It did exist before, not for them. It existed since Obamacare started in 2010 or whatever it was.
But it was much
all the
higher.
way through COVID. Right. And now the cliff was taken away short term with the enhanced subsidies. Now it's back. People need to be. So that's number one. Okay. Number 2, Tony, because I said I'm only going to do 2 today. I don't want to go too far. Use a health savings account. Now,
you've done whole shows on this.
Done some whole. I put them up there. This is the beautiful, beautiful health savings account. Number 1. It should be my number 1, but it's number 2 in this case today. There's some new rules, okay, about health savings account, and more of you listeners are going to qualify. Here's the way the rule has changed. Starting in 2026, all bronze and catastrophic health plans qualify for health savings accounts. All of them. This was part of the Working Families Tax Cut legislation signed by President Trump in 25. So what that means is that back to that couple in Wisconsin, they picked that cheap plan. It didn't say HSA compatible. Yeah. It doesn't matter. It's a bronze level plan. It's going to allow them to open up an HSA.
Really?
And why is that important? Because an HSA can be really, really helpful in avoiding the cliff. And let me explain what I mean by that.
Oh, I know exactly what you mean.
So 2026, here are the HSA contribution limits. And I'm doing a family. It's about half if you're an individual. For a family next year, they could put $8,750 into a health savings account. Okay? If in the case of the couple we just went through, they're both over 55, they get an additional $1,000 each that they could put. So technically, they could put $10,000 $10,750 next year into an HSA.
Wow.
Okay. Well, that's great, Dan. And you could use that HSA to pay for health insurance costs, healthcare costs.
Premiums, deductibles,
You
copays.
you could use it to help pay for medical things that you're going to have.
Medication.
But if you don't have any medical needs and you don't use it, it rolls forward and it carries forward and it can grow tax-free. But here's the key.
Nice.
Here's the key. Health savings account can be used to pay for expenses. It can grow tax-free, so you can invest it and have it grow. And when you take it out, it's tax-free. Everything you put in is tax-free. Everything you take out is tax-free as long as you use it for medical.
And it grows tax-free.
And it grows.
You don't have
any
to pay
interest
taxes
you
on the
gain,
growth. Yeah.
any growth, interest, earnings, or tax.
It's the
But here's the
only
key.
type of account under the IRS tax code that has that triple tax break, where it goes in tax-free, it grows tax-free, and it comes out tax-free. And that's why you said
Exactly.
it's the best.
It is. And when you say it goes in, like, it's not a Roth, because a Roth you could put in, grows tax-free, and you can take it out tax-free, but you don't get to deduct it off your taxes when you put it in.
You get a
When
deduction.
when you add to it HSA, and this is really important for 2026, it reduces your reportable income. It reduces the top line income that you would then say to the healthcare.gov, here's what my income is, what's my subsidy? So now imagine that couple from Wisconsin. They didn't plan, or they, whatever it is, they put $90,000 as their income for 2026. And they're like, oh my gosh, man, we missed the cliff. We're over the cliff. We're getting nothing. They could put 10,000 into an HSA, and now their $90,000 income goes to 80, according to the healthcare.gov formula for what's your income. So they've effectively reduced their income. They haven't changed their actual assets. They just repositioned it from their savings account or their IRA over to a health savings account.
Yeah.
So they now have that reduced taxable income modified to just a gross income, which would reduce the income they tell the government they're going to make, which increases their subsidy and might push them from not getting anything to getting $20,000 in subsidies.
There you go.
Huge.
That is huge. And some might argue, well, Dan, I have to put that $8,000 to $10,000 into an HSA, and that's just for medical. What if I'm healthy? I'm probably not going to use that this year or next year. And then I can only use that money for medical. So is it like I really still have that $10,000? But the answer is yes, you do, because between now and the end of your life, you're going to have large medical expenses. It averages between $150, it's over $300,000 a couple that spends between when they retire and when they pass. That's the average amount the average couple will spend on medical costs. So that $10,000 is you're going to make that back and more, because you're never going to have to pay taxes on it. You can buy aspirin with it. You can get glasses or pay for hearing aids. I mean, there's so many things you need in retirement. Dental, it covers all of that, right?
Yes,
HSAs.
that's a good one. Dental's a good one because a lot of Medicare doesn't cover dental.
No.
Well, I'm going to be on Medicare. Can I do this? No, you can't. You can't add to an HSA and be on Medicare, but then you're not worried about the health insurance cliff because you have Medicare. There's
Hearing, vision, and dental isn't
subsidy.
covered by standard Medicare. Now, there are some Advantage plans that cover some
Right.
of that, but not all.
Right.
And there are still,
Right.
with Medicare, premiums, copays, deductibles.
Yep.
People
Co-insurance,
don't understand
right?
that. Medicare doesn't cover your health costs. It helps,
Right.
but it's just a form of
right.
insurance. Yeah.
And we did the show on it, health savings accounts, and how you can use the health savings account money today for an expense you had 5 years ago, if you do it right. So yeah, I agree, Tony. It is really important to know. When they were coming out with legislation, no tax on Social Security and so on, I remember telling you, I want everyone to be able to have an HSA, regardless of what kind of plan they have. I think HSAs should be available to everyone, even if they get coverage through their employer.
Sure.
I think the government should not be taxing any income, any money that you're using to pay for health insurance, healthcare needs.
And unfortunately, it's still only high deductible plans that allow
no.
HSAs.
Well, it used to be only high deductible. Yes, true, but it used to be only high deductible plans that the government said qualify, and there was typically maybe one in the entire county available to you. Now any bronze plan is available.
Yeah, if you're getting insurance through the exchange, it's opened it all up, basically. The bronze level,
unless you're on a silver plan. Unless you go on a silver plan, but those are going to be outrageously expensive for people that are above the income threshold. Right. So, so that's what I let you know what it's time for, Tony.
Let's wrap this up.
Listeners
I
on
love
Spotify,
that.
iTunes.
That's a fun one.
That was a video of me wrapping Tony in cellophane or saran wrap or whatever it's called.
That's awesome.
So, Tony, to conclude, wrong conclusion. Wow. Health insurance is broken. It's truly broken. Health insurance is broken. I'm not going to go down that rant. Maybe another show. And you need to be really engaged, especially this year going into 2026. You need to be engaged with your financial planner and your accountant about costs for health insurance. I know that's my insurance agent job. No, you need to be active on this. You need to be proactive. Because if you're going to open up an HSA, you got to open up at the beginning of the year. You can't. You gotta make sure you're on the right plan.
Yeah.
You can't go mid-year on a plan. You have to do this from the start to get the full write-off capabilities, and you have to be able to project what your income is going to be in order to get a subsidy. And it's all reportable. The government's on it. They're going to reconcile this. There's no, fudging the numbers. You got to do this right, because the amount of money at stake has gone up now that the enhanced subsidies are on the fence. Most likely not going to be around. That's the way I want to conclude, Tony.
All right. Well, I think you wrapped it up nicely in a nice bow there, but very important, critical information for people. It could mean the difference between, really thousands. It could save them thousands of dollars.
Absolutely. Thanks for a good show, Tony. We'll catch everyone next week.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.